In this video, I share a brand new growth stock that I've been buying recently after their stunning Q2 earnings that I believe could 10x or more in the coming years. Now, what if I told you this is a company with 80% gross margins where 90% of their revenues are totally recurring, and they've been growing them at a compounded annual growth rate above 50% since 2016. It only has a $1 billion valuation while the total addressable market opportunity is worth over $70 billion. And finally, this company has an amazing product line that has attracted customers such as Amazon Web Services, among many other huge enterprises. So what is this company that's too good to be true, you might ask? Well, the stock I've been buying is Docebo with ticker symbol DCBO on the NASDAQ or DCBO.TO on the TSX here in Canada. Despite being up over 240% since its IPO back in late 2019, Docebo stock is down 60% from its all-time high of $117 per share last year. So is this dip presenting a great buying opportunity for long-term growth investors? Well, in today's video, I'll be explaining why I've personally been buying Docebo stock, some of the growth drivers for Docebo, and then we'll talk about the valuation and where the stock could potentially be heading. With that said, please remember to drop a like if you do enjoy this video. That would really help me out, guys. And also, I wanted to thank today's video sponsor, INVRS, but more on them later. Alright, so to start, I'll give you a quick summary about the company and why I love it so much. Docebo is a cloud-based e-learning platform where they're positioned in the quickly growing segment of enterprise learning management systems, or LMS. So Docebo isn't a public learning platform like Chegg or Udemy, for example. Instead, they focus on internal and external enterprise learning with real-time tracking of training results, optimizing time, and reducing costs associated with traditional learning methods. For example, some of the AI-powered feature sets that Docebo offers are auto-tagging learning videos, deep search functionality, and virtual coaching capabilities. Now, this is a company that resonates with me personally. As an engineer that works at a big company, I do have to use an LMS called SumTotal, and I absolutely despise it. So I can see an innovative company like Docebo gaining a lot of market share in the LMS industry. In fact, the LMS industry is projected to grow at a compounded annual growth rate of 19.1% until 2030, where it's expected to be worth $76 billion, which is also about 76 times the size of Docebo's enterprise value today. Needless to say, Docebo has a very large opportunity in a fast-growing industry, and it's not just a COVID trend. According to a study performed by the Fosway Group, Europe's #1 HR industry analyst, 67% of companies say they won't switch their learning strategy and investment resourcing back to the way it was pre-pandemic. And this study is proven by the fact that Docebo's been able to maintain incredibly high growth rates despite the end of the pandemic. But now let's take a deeper look at their Q2 earnings report from August 11th. The first thing we can see is Docebo's revenue came in at $34.9 million, an increase of 36% year over year. However, revenue actually increased 47% year over year after excluding a one-time catch-up amount of $1.1 million in the same quarter last year, as well as negative foreign exchange impacts. Of their total revenue, subscription revenue came in at $31.9 million, representing 91% of their total revenue. As such, their annual recurring revenue, or ARR, came in at $138.2 million, up 48% year over year, or 51% growth after accounting for negative foreign exchange impacts. Moving along, we can see their gross profit came in at $28 million, an increase of 37% year over year, which represents an 80% gross margin. And I just want to take a moment to highlight how incredible this 80% gross margin is. It's very uncommon to find a company like this, but because Docebo does have so much recurring subscription revenue, they have incredibly high margins. Next, Docebo actually posted an adjusted net loss of 5 cents per share after accounting for a foreign exchange gain, and we can see that here in their adjusted EBITDA loss of $300,000 in the quarter compared to an adjusted EBITDA loss of $2 million for the same quarter last year. We can actually see that Docebo did improve their profitability year over year. They were also free cash flow positive of $900,000 compared to negative $800,000 for the same quarter last year. So overall, Docebo is a stock that's on the verge of full profitability, which is a great sign, and they should be very profitable in the future given their huge 80% gross margin. And that also means there's significantly less risk in this investment versus some other stock where profitability might not even be in sight, for example, Tattooed Chef. Now, aside from the financials, here's some other really great points that I found from their Q2 earnings report. Docebo now has 3,106 customers, up 25% year over year, where they just signed on several new companies, including Chipotle, and they expanded their partnership with AWS. Docebo's average contract value has continued to rise year after year, and this quarter was no exception, where it grew to $44,500, up 18% year over year. Then we can see their net revenue retention, or NRR, was 113% 13% for Q2, and this just means that existing customers keep spending more and more each year on Docebo products. Finally, we can see just how capital efficient Docebo really is, where they've only spent $15 million in cash burn since 2016 to grow their annual recurring revenue to $138 million. So I love to see that the business is very efficient with the capital that they're spending and they're not wasting investor resources. Now, before we get into Docebo stock's valuation, I wanted to tell you about our sponsor INVRS. INVRS is a completely free stock research platform and social media outlet for investors. Basically, they make it incredibly simple to analyze a stock you're looking into buying, like Docebo, since they gather all the financial statements and stock data into one place. For example, we can see Docebo's revenue growth over time being a clear exponential trend here in INVRS. Then when it comes to their balance sheet, INVRS shows us they have cash and cash equivalents of $212.3 million, while their current liabilities are $76.3 million, including $50 million of deferred revenue. We can also see that Docebo barely has any short-term and long-term debt, only adding up to $3.6 million, which does signal a very healthy balance sheet since they have over $200 million in cash. Anyways, you can also share your stock analysis on INVRS in the main news feed, where many other investors will be able to comment on it and see your stock picking ideas. And likewise, you can also engage with other investors' posts on the platform or join their group if that's your type of investing style. I personally use INVRS all the time now since I find it super engaging and user-friendly, so if you want to join INVRS for free, click the link in the description down below and you'll gain access to a free stock research platform and social content. But with that said, let's get straight back into Docebo stock's valuation. Now, because Docebo is still an unprofitable company, we're not going to be able to calculate the price to earnings ratio or anything like that, but we can calculate some price to sales ratios and EV to sales. So given Docebo's Q2 revenue of $34.9 million, we can update their trailing 12 months revenue to be $123.9 million. Now, we can find in Docebo's Q2 earnings report that they have 34 million shares outstanding. So if we multiply that by the US dollar share price of about $36 per share, that gives us a market cap of 1.24 billion US dollars. So if we divide their market cap of $1.24 billion by their trailing 12 months of revenue of $123.9 million, that gives us a trailing 12 months price to sales ratio of exactly 10. But it only gets better from here if we annualize their Q2 revenue of $34.9 million, which would end up giving us $139.6 million in a year. And in that case, their Q2 annualized price to sales ratio would end up being 8.9. Finally, we already found that Docebo has a lot more cash on the balance sheet than they do have debt. In fact, about $200 million more, so we can subtract that from the market cap, and that would end up giving us an enterprise value of $1.03 billion. So then if we calculate their Q2 annualized EV to sales ratio, that ends up being 7.4, which really isn't that bad at all, especially for a company with 91% recurring revenues and extremely high growth rates. So finally, let's discuss some future growth drivers that could make Docebo a 10x stock in the future. The first and most obvious growth driver would be customer growth. Currently, Docebo is growing their customer base at 25% year over year, so as long as they continue gaining market share in North America, they can continue growing their customers. But keep in mind too, only 25% of their revenue comes from the rest of the world, and the 75% revenue comes from North America, so there's still a big opportunity for geographical expansion, especially in the Asia Pacific area and Europe. Another way they'll be able to grow their customer base is through the industry growth driver, which will be 19.1% compounded annual growth rate until 2030, as many more enterprises start adopting a learning management system. Now, the second main growth driver for Docebo would be their ACV growth, or their average contract value growth. As we already know, Docebo's Q2 ACV grew to 44.5K, up 18% year over year. Now, this of course can come from new customers, but also by upselling existing customers too. They could also grow their ACV by having new product launches and adding more value to the platform and the products that they offer to their customers. Finally, Docebo is an AI-based company, so using AI to improve the overall value proposition of their services will naturally increase the value, and they could potentially increase prices if they do increase that value enough. Third and finally, Docebo will be able to grow their revenue through opportunistic acquisitions. But personally, I am opposed to acquisitions. I would much rather see organic revenue growth because their margins are already so high at 80%, and any acquisition would probably dilute their margins. So anyways, with all of that said, what are my overall thoughts on Docebo stock? Well, I truly see Docebo as an incredible investment opportunity, seen as they are growing so quickly, their margins are so high, they have recurring revenue revenue, and it's in a growing industry too. Also, given Docebo's capital-efficient growth and strong balance sheet, it's highly unlikely this company will need to raise any money within the next 5 years unless they plan on making a major acquisition, which is great news for shareholders. But the only major concern I do have about Docebo stock is their potential competition. I don't know if Docebo really has durable competitive advantages outside of their switching moat, where it becomes difficult for their customers to leave once they are using the Docebo product suite. However, as far as I'm aware, Docebo is the only LMS in the industry using AI to enhance their products and services, as well as their integration with other software like Salesforce and Shopify, so those are competitive advantages for now, but are they durable or are they moats? I'm not sure about that. Also, they do spend about 42% of their revenue on marketing, so clearly there is a decent amount of competition within this industry. So I'm hoping over time that Docebo can begin to reduce this marketing spend as a percentage of their revenue to become more profitable. But aside from competition, I do love Docebo stock, and they have proven to do very well over history. I think this stock could have the potential to 10x over the next decade, or it could be acquired at a huge premium by another business-related company like Salesforce, Shopify, or Microsoft, and that way it would integrate very well with their product suite. Either way, with this stock, there seems to be massive upside and limited downside, so that's why I'm buying the stock. Anyways, I'd love to hear your thoughts on Docebo stock down below. Would you consider buying this stock and researching it further, or do you not like the stock? Let me know why. I would love to hear it. So make sure to leave a like if you did enjoy this video, and with that said, I'll see you all in the next one.